Brian and Jessica started the same job, at the same company, on the same Monday in 2010. Same salary, $62,000, same retirement plan options, same enrollment meeting in the same conference room with the same HR presentation. Brian checked the box for the traditional 401k. The tax deduction sounded smart. Why pay taxes now when you can pay them later? Jessica checked the box for the Roth 401k. Pay taxes now, never again. It felt cleaner. Neither of them ran a single number. They each decided in under 90 seconds, based on a feeling. 16 years later, they have contributed exactly the same amount. Their accounts hold exactly the same investments. And the difference between what they will actually be able to spend in retirement is $174,000. One of them chose right. One of them chose wrong. And here is the uncomfortable part. The right answer was knowable in 2010. It just required asking one question that the HR presentation never mentioned. In this video, I am going to run the real math on the 401k versus the Roth IRA. 3 complete scenarios, exact numbers, every tax accounted for. By the end, you will know which one is right for you, and more importantly, you will know the one question that determines the answer. Because the default answer, the one most people get from HR, from Reddit, from their parents, is wrong for most of the people receiving it. Let me give you the question first, because everything else in this video flows from it. Will your tax rate in retirement be higher or lower than your tax rate today? That is the entire decision. Everything else, the contribution limits, the employer match, the RMD rules, the withdrawal flexibility, matters at the margins. But the core mathematical engine of the traditional versus Roth decision is a comparison between 2 tax rates, the one you pay now and the one you will pay later. Traditional means deduct now, pay taxes later at your future rate. Roth means pay taxes now at your current rate, never pay again. If your future rate will be lower than your current rate, traditional wins. If your future rate will be higher, Roth wins. If they are identical, the two produce exactly the same after-tax outcome. And I will prove that with numbers in a moment, because almost nobody believes it the first time they hear it. The problem is that most people answer the question wrong. Not because they are bad at predicting tax rates, but because they compare the wrong things. They compare their current marginal bracket against an imagined retirement where they have almost no income. The reality of their retirement income is usually very different. First, let me prove the claim that surprises everyone. If tax rates are equal, traditional and Roth produce identical outcomes. Take $10,000 of gross income. Tax rate 22%, both now and in retirement. Investment growth 100% over the holding period. The money doubles. The traditional path, contribute the full $10,000 pre-tax. It doubles to $20,000. You withdraw it and pay 22%, $4,400 in tax. You keep $15,600. The Roth path, pay 22% tax first, $2,200, and contribute the remaining $7,800. It doubles to $15,600. You withdraw it tax-free. You keep $15,600. Identical to the dollar. The order of taxation does not matter when the rates are equal. Multiplication is commutative. This is the mathematical foundation of the entire decision. And it means the only thing that matters is the difference between your rate now and your rate later. So the real question becomes, what will your rate actually be in retirement? And this is where Brian and Jessica's stories diverge. Scenario 1. Brian, the traditional contributor. Brian contributed to his traditional 401k for 16 years, rising from $62,000 to $118,000 in salary. His contributions plus growth now total $487,000, and projecting forward to retirement at 67, his traditional balance reaches approximately $1,650,000. During his working years, Brian's marginal rate averaged 22%, occasionally touching 24%. Every contribution saved him taxes at those rates. Total tax deferred over his career, approximately $96,000. It felt like winning every single year. Now look at his retirement. His required minimum distribution at 73 on a $1,650,000 traditional balance, grown to roughly $1,900,000, approximately $71,700 in year one, mandatory, whether he needs it or not. Add his Social Security of $38,000, of which 85% is taxable. Brian's taxable retirement income, approximately $104,000 per year. His marginal bracket, 22%, exactly the same rate he deferred at. His Medicare surcharge, an additional $100 per year because his income crosses the first threshold. His deferral saved him nothing, and the surcharge means he actually pays slightly more than if rates had simply been equal. Brian deferred taxes at 22% to pay taxes at 22% plus Medicare surcharges. The strategy that felt like winning every April was, across his lifetime, a small net loss. Scenario 2. Jessica, the Roth contributor. Jessica paid taxes on every contribution at the same 22 to 24% rates Brian deferred at. Her after-tax contributions were smaller in nominal terms, but every dollar in her account is entirely hers. Her Roth balance at 67, approximately $1,150,000, the same gross number as Brian. But the comparison is not the balance, it is what the balance buys. Jessica's withdrawals are tax-free, all of them, forever. Her taxable income in retirement is just her Social Security, $38,000, of which much less is taxable because her Roth withdrawals do not count toward the provisional income formula. Her federal tax bill in retirement, approximately $1,900 per year. Brian's, approximately $14,800. No required distributions. Her money compounds untouched as long as she wants. No Medicare surcharge. Her premiums stay at the base rate, saving $100 per year versus Brian. And when she passes, her heirs inherit the Roth tax-free. The lifetime difference between Jessica and Brian, identical contributions, identical investments, identical balances, comes to approximately $174,000 in after-tax spending power, in Jessica's favor. Same job, same Monday, same conference room, 90 seconds of unexamined instinct, $174,000 apart. Subscribe before we continue. Because the third scenario is the one that applies to most people watching, and it is the one nobody talks about. Quick note before we go further. I am not a financial advisor, and everything I share on this channel comes from my own research and analysis, not professional credentials. Brian and Jessica are composites built to illustrate real tax mechanics, and the numbers are illustrative examples, not personalized advice. Tax rates, brackets, and rules change. Before making any decision about your retirement accounts, please consult a qualified financial advisor or tax professional who knows your complete picture. Now, let's continue. Scenario 3. The split, and why it beats both. Here is what neither Brian nor Jessica considered. You do not have to choose. And for most people, the mathematically optimal answer is both, in a specific proportion, for a specific reason. The reason is that retirement income is not taxed at one rate. It is taxed in layers. The first dollars you withdraw each year fill the standard deduction, taxed at 0. The next dollars fill the 10% bracket, then 12%, then 22%. Your last dollar might be taxed at 22%, but your average rate across all withdrawals is far lower. This creates the optimal strategy. Use traditional contributions to fill the low brackets in retirement and Roth withdrawals for everything above them. Run the numbers on a third colleague, call him Marcus, who split his contributions. Enough traditional to generate retirement withdrawals that fill the standard deduction and the 12% bracket, roughly $60,000 per year of traditional income for a single filer. Everything above that went to Roth. Marcus's retirement, his traditional withdrawals, are taxed at an average rate of about 8%, far below the 22% he would have paid on that income while working. That is the traditional advantage, captured properly. Everything else comes from his Roth, tax-free, keeping him below every Medicare threshold and keeping his Social Security mostly untaxed. Marcus's lifetime after-tax advantage over Brian, approximately $212,000. Over Jessica, approximately $38,000. The split does not feel clever in any single year. Across a lifetime, it beats both pure strategies. So here is the framework, the honest version of the answer, by situation. Roth wins clearly when you are early in your career and your current bracket is 10 or 12%. You are almost certainly in the lowest tax years of your life. Paying tax now at 12% to avoid tax later at 22% is one of the best trades available in personal finance. Every young person defaulting into traditional because the deduction sounds adult is making Brian's mistake at the worst possible time. Traditional wins clearly when you are in your peak earning years at the 32% bracket or above, and you expect substantially lower spending in retirement. Deferring at 32% to withdraw at an average rate of 12 to 15% is a genuine arbitrage. High earners in expensive states moving to low-tax states in retirement get an additional discount. The split wins for almost everyone in between. The 22 to 24% brackets, which is where the majority of serious savers live. Enough traditional to fill the low retirement brackets, Roth for the rest. And remember, the employer match always goes in first, regardless of type. It is a 100% return that overrides every other consideration. One more rule that overrides the framework. If your traditional balance is already on track to exceed roughly $1,000 by your late 50s, your required distributions are already going to fill your low brackets for you. Every additional dollar should lean Roth, because Brian's problem is already built into your account. 3 objections answered directly. Objection 1. Tax rates are historically low. They have to go up. Maybe. Current rates are scheduled to revert upward, and the national debt suggests pressure in one direction. But Congress has extended low rates before, and your personal bracket in retirement depends far more on your withdrawal strategy than on legislation. Do not bet your entire retirement on a political prediction. The split strategy is precisely how you hedge that uncertainty. Objection 2. The deduction lets me invest more, only if you actually invest the tax savings. Brian's $2,200 annual tax savings did not get invested. It dissolved into his lifestyle, the way deferred tax savings almost always do. If you genuinely invest every dollar of the deduction in a taxable account, traditional improves meaningfully. Almost nobody does this. Be honest about whether you will. Objection 3. I'll be in a lower bracket in retirement. Run the actual number instead of assuming it. Project your traditional balance to 73 at 6% growth. Divide by 26.5. Add your Social Security. That is your forced taxable income, before you have chosen to spend a single dollar. For disciplined savers, that number lands in the 22% bracket, or higher far more often than they expect. The assumption of a lower bracket dies on contact with the required distribution math. Here is what I want you to take from this video. Brian and Jessica made a 16-year, $174,000 decision in 90 seconds in a conference room, based on which sentence in an HR presentation sounded smarter. Most people watching this made the same decision the same way. The decision was never traditional versus Roth. It was always, what will my tax rate be in retirement? And the answer to that question is not a guess. It is a calculation you can run this week with 3 numbers: your current traditional balance, your years to 73, and your projected Social Security. Run it. If your forced retirement income fills the 22% bracket, you already have enough traditional, lean Roth from here. If it barely fills the standard deduction, the traditional deduction is genuinely valuable to you. Use it. If it lands in between, split, and let each account type do the job it is mathematically built for. 90 seconds got Brian a $174,000 mistake. 20 minutes of math gets you the right answer for the next 30 years. Tell me in the comments, traditional, Roth, or split? And did you actually run the numbers before choosing, or did you decide in the conference room like Brian? I read every single comment. Subscribe, because next week we are covering how much the average 45-year-old actually has saved in 2026, and where you stand against the real numbers, not the numbers people admit to. You will not want to miss it.